Rajat Jain, Chief Investment Officer with Principal PNB Asset Management, joins us now. Rajat, good morning. Thank you for joining us. What is your market view? More pain is there, or we are nearing the end of the decline?
Thanks for having me, Nikunj. Now, I think this year is certainly going to be one volatile year. I think volatility coming from obviously locally, I think on the ground, you see things improving at the micro level. You see commentary from all the consumer goods companies, two-wheeler companies, even actually the capital goods companies. They are saying while no greenfields are being announced, but clearly there is even outside of roads, railways, ports, brownfield certainly is happening, and better things actually in the Q3 numbers from the capital goods companies as well. On the macro, however, India, I mean, we had a great macro. It's beginning to slightly deteriorate. It's not bad, but I mean, certainly we have a potentially higher current account deficit. Probably we exceed 2% this year. Oil has something to do with it. Our export growth is not the way, it's not fully levered to what the global exports are. And of course, inflation and a risk of a slippage to fiscal deficit in FY19. So, I mean, plus flows, I think globally flows are going to be very choppy, though emerging markets as a category should get flows, but they'll be very volatile in the environment of rising rates and so on. So it's difficult to call where the recent fall is it's over now for the moment, but still overall we still think you get positive high single digit returns for calendar 18 is our sum and substance what we really believe for the year.
Rajat, how real are the macro concerns which have come to fore now, whether it is rising inflation, what's happened to crude, and the fact that bond yield is now at 7.6%? And we both know that interest rates, they act like gravity, and when interest rate cycle turns, equities as an asset class will underperform.
Sorry. On the macro, I think the point I made earlier that yes, things are not as good as they were last year or the year before that, but they're not, I mean, totally out of whack. We have come down a bit. We'll probably see some pressure, but are we? I mean, we're not going to see things blowing up as it were. So I think that's our sense on the macro. On the interest rates, I think 10 years about 765 or thereabout at this point of time. Our view is that the inflation certainly is high in the first half of the year. Second half of the year, I think inflation probably begin to moderate, partly because of the base effect, and depending on how the rains are, how we have the Rabi crop, how that pans out for this year, all of that. So we certainly see a deteriorating macro, but something we don't see things blowing up as it were. Slight deterioration, but so all said and done, that will probably actually, if you come to graft it to equity, what happens to equity? I think it's more about the P multiples. It's really, I think India is about probably 18 times, give or take, FY19. So it's not in bubble territory. It's not cheap. So I think probably it's more of sideways movement for a while. So, but we don't see the markets as in taking a big fall, big tumble. That's our base case.
Rajat, hi, morning. So, for a smart investor, it's always about capital protection. As you say, that it's going to be a very sober 2018, and unlike the high flyer 2017 that was, wherein you buy any mid and small cap stock, quality name, of course, at that, and you knew that by the end of the year, you'll make a 35 odd % return kind of. And so was the case with large caps too, selectively. What is it that you do right now? Where is it that you profit take? And where is it that you stay invested?
So I think for the average investor, I think equity is still probably not so great, 18, but still I think a place to be for a medium-term investor looking to 3 to 5 years out. For the fund managers, in terms of our portfolios, I think we still are constructive on the cyclical recovery in the Indian economy. So our portfolios are more geared. For example, autos is a big bet for us, coming out of the fact that the consumption, two-wheelers is looking good. I mean, we are selling about more than three-wheeler, 3 million cars and UVs now. It's a very, very substantial number, and these are pretty well-run companies. So auto is something that we have. Financials, we still like financials, though it's really been three pillars there. So large PSU banks, um, private sector banks clearly. We also have added, I mean, we always had, but we have added further to the corporate sort of oriented private sector banks, and selectively NBFCs. And NBFC is a space where there's been a lot of fresh capital come in. Valuations aren't cheap, and NBFCs are all over. I mean, there are NBFCs and NBFCs. So selectively, we have NBFCs in our portfolio. That's about financials. We have also added to IT. IT, we had a big underweight position. We have reduced that and added to that in the last couple of quarters, coming out of low valuations, a world economy which is chugging along reasonably good, probably leading to strong IT spend. These companies are good companies. Indian companies, mid-sized companies are pretty well run, and so IT is something that we have added to our portfolios. So I think it's not going to be, as you rightly said, not by, it's more stock specific, which means active funds actually should do better this year. Active funds have done well in India, so I think this will be a more year for stock picking and being selective in what you buy in your portfolios.
Okay, I think we lost Aisha there. But meanwhile, if I just have to mark markets, we are off from the day's high once again. So at high level, the selling seems to be coming. Selling seems to be coming, as it is evident that the mid-cap breadth has caved in, and it is also evident that higher levels FI, they continue to sell, and they continue to sell the market lower. Rajat, given where the valuations are, given where US economy is, I personally get a sense that our market's underestimating when a cozy trade like long dollar, short dollar and long emerging market changes. My only fear is that if this cozy trade of short dollar and long emerging market changes, it could have far-reaching repercussions. And frankly, we may talk great about our markets, but we are joined to the hip when it comes to global markets. Dow is up 20% last 1 year, so are we.
Yeah, actually, I missed part of your question. Is it when this? I mean, do we have this? So we have this trade of. I mean, so do we see a flight of capital from emerging markets, and what happens to India? Because last year MSCI emerging market in India did virtually. We did exactly what the markets did. I think. I mean, while the US yields are high and the dollar still remains, the dollar index is, I think, sub 90, even 88 or 89. We don't, I mean, that has not sort of changed. If yes, the dollar were to strengthen, and that's debatable. I mean, we don't see that change in a hurry. If that were to happen, yeah, that could have an impact on emerging markets. But for the interest, I mean, about the US at about 290 or thereabouts. And I'm not an expert on what the US economy does, what happens to the US economy. But our sense is that Indian markets, we continue to see decent flows domestically. And I know from talking to investors and distributors, there's been a fair amount of money on the sidelines ever since the markets were probably about 10 or 15% lower from here. So one of the reasons we are more constructive also is we do expect that money which has been on the sidelines for a while to come back into the markets when the markets do correct. So at least, so we do not see at least the markets taking a big tumble simply because it should be supported by local monies.
By PSU banks, because the bad news is out in the open. I mean, the emperor has lost his clothes.
Sorry, Nikunja, I missed that. For PSU banks?
Tempted to buy PSU banks because we all know the bad news now. And do you think all the bad news is in the price?
Oh, okay. So actually, in our PSU banks, I mean, I think the large PSU banks is what we have in our portfolio. Uh, Two or three large ones, and I think they are as good as private sector banks, at least in operationally, in terms of how they run their business. So we didn't really play this so-called recap trade and so on, because we ultimately bought the fundamentally well-run PSU banks, and I think yes, we think they're still attractive. While every bank has corrected, PSU bank has particularly corrected, given the events the last fortnight or so. But we think there is, I mean, these large PSU banks, I think we should come out of it. I think this is an event which is probably isolated in a few limited cases. It could have ramifications, but certainly the larger ones I think will be better poised, better placed to manage these things. And so we are not cutting our position in the large PSU banks.
Rajat, as a percentage of your portfolio, how much cash levels are you sitting on, and how long are you willing to wait it out to deploy that money back into the market?
We don't, as a fund house, take large cash calls in our portfolio. So our funds would have cash levels of somewhere between 3, 4, at the most 5%, actually more like a 3 to 5%. So which is, I mean, probably on, if you go back 2 quarters ago, probably we had 1 to 2%. So slightly higher cash levels, but not very meaningfully large cash levels. So I think these markets are giving you chances, are giving you opportunities. Especially in, say, well-run mid-cap companies. If you look year to date, I think till yesterday, the mid-cap index was down about 8 odd percent, if I remember right, and some stocks are down much more. So if you get some of those at a fair price with liquidity, I think you certainly look at those. But as I said, it's more about stock picking this year. You really got to test your assumptions, so that you test your valuation numbers and see how your earnings are going to come. And once you are confident, I think there's no harm at all buying into those even mid-cap companies at this point of time.
That's an interesting point. Rajat, I didn't hear you talk about metals. Considering how fabulous all of 2017 has been, even now you're at the peak of the commodity cycle. Is it time to start profit taking and taking some chips off the table if you have been invested in metals? Or would you say that this upturn in the cycle is going to last for some more months to come?
At least we are in the second camp. We do believe that, led by the global recovery, I mean, oh, the Europe, US, and Japan are all doing well. So that's the first part of the story. Second is there have been somewhat capacity shutdowns, as we know, in China for different reasons. Certainly, pollution and environmental considerations being one of them. That has an impact as well. So we are actually, I mean, we have about 4 to 5% of our portfolio in metals, and we still think that I think metals still look reasonably constructive at this point of time in the markets.
Okay, great speaking with you, Rajat. Thanks so much for taking the time out and sharing with us your views on your likes and dislikes in the market and the overall market view as well, wherein Rajat does believe that much unlike 2017, it's going to be a rather somber 2018, so don't have massive return expectations from your portfolio. And unlike 2017, again, you can't really paint the entire sector, individual sectors with the same brush. You've got to be stocks specific and very selective in this year in any case.